Did you know that most Americans are on track to run out of money in retirement? Yeah, that's terrifying, but it doesn't have to be your story. The truth is, too many people are so caught up in the now that they forget to invest for their future. And while retirement might seem like it's far off, the earlier you start investing, the better off you'll be. Here's the good news. You don't need to be a millionaire to get started. In fact, you can just start with $100 a month. That's $25 a week, or roughly $3.50 to $4 a day. This can set you up for major long-term growth. That's right, those small contributions over time can grow into hundreds of thousands or even millions by the time you retire. In this video, I'll break down 5 of the best Fidelity Index Funds and ETFs that are perfect for building a strong retirement portfolio. I'll show you how much you can earn from each of these funds, and in the end, I'll show you a Fidelity Index Fund that has the potential to turn your monthly contributions into a portfolio worth over $2 million and pay over $40,000 in monthly dividend income. Now you might be wondering, why Fidelity? Why not any other investment company? Well, here's the deal. Fidelity has built a solid reputation as one of the most trusted names in the investment world. What really sets them apart is their low-cost, diversified index funds and ETFs that cater to a wide range of investment goals, whether you're chasing growth, income, or long-term stability. But how do you choose the right funds? That's where things get interesting. When picking investments, there are a few key criteria to keep in mind. First off, cost matters. Fidelity's funds are known for having low fees, which means more of your money stays invested. Second, diversification. Each of these funds I'm looking at offers exposure to a range of sectors or international markets, reducing risk by not putting all your eggs in one basket. Lastly, I considered historical performance and future growth potential. The 5 funds in this video have shown strong performance historically and have promising outlooks. By sticking to these criteria, you can rest easy knowing that your investments are designed to grow steadily over time. And remember, it's not about timing the market, it's about time in the market. Alright, let's kick things off with a fund that's all about stability and reliability. The Fidelity Investment Grade Bond ETF, or FIGB. If you're someone who prefers not worrying about the wild swings of the stock market, FIGB could be your best friend. This fund invests in investment-grade bonds, which are issued by companies or governments with strong credit ratings, meaning they're less likely to default. So while FIGB might not be the most exciting part of your portfolio, it's certainly one of the safest. Here's how FIGB works. It's designed to generate steady income through dividends rather than rapid growth. And FIGB passes that income along to investors. Right now, FIGB has a current dividend yield of 4.14%, which means you're getting a decent income stream relative to the amount you invested. But here's where it gets even better. Those dividends can grow over time. FIGB's dividends have an average growth rate of 7% per year, meaning your income from this fund can increase steadily over time, even if the share price doesn't move much. Now, if you're investing $100 a month, which adds up to $1,200 a year, what kind of returns can you expect? Well, in just 1 year, you'll have your $1,200 investment. Simple, right? But if you keep at it, things start to get interesting. After 10 years, your investment will grow to $16,090, and after 20 years, it could be worth around $68,140. Fast forward to 30 years, and your investment could grow to $538,414. And let's not forget about dividends. By the 30th year, you could be looking at $122,226 in annual dividends, which equates to about $10,186 per month. That's money going directly into your pocket, or better yet, being reinvested to grow even more. Of course, we need to talk about capital appreciation, or in this case, the lack of it. The thing with bond ETFs like FIGB is that you're not going to see much movement in the share price. In fact, FIGB's average share price appreciation is 0.00%. That might sound like a bad thing, but it's actually not. FIGB isn't designed for price growth. It's designed to pay out a steady income, and that's exactly what it does. The real value here is in the dividends and how they get reinvested to grow your overall portfolio. So after 30 years of investing $100 a month, FIGB won't have given you much in terms of capital appreciation. But thanks to the power of dividend reinvestment, your portfolio could still be worth $534,414, with $502,414 of that growth coming from reinvested dividends. Next on my list is the Fidelity International High Dividend ETF, or FIDI. This fund opens the door to investing in international companies. Why is this important? Well, sometimes markets outside the US can offer unique opportunities and, in some cases, higher dividends. FIDI is all about capturing that opportunity while paying you solid income through dividends. Here's what makes FIDI interesting. It focuses on high dividend-paying stocks from international companies. You get exposure to markets around the world, which helps diversify your investments and spread out your risk. If the US market is having a rough patch, international stocks might be performing better. This diversification helps stabilize your portfolio over time. At its core, FIDI is designed for income-focused investors. The fund currently has a dividend yield of 5.13%, which is quite appealing, especially for those looking for higher cash flow. That means for every $100 you invest, you're getting around $5 back in dividends each year. Not bad for something you don't have to actively manage. Plus, these dividends aren't stagnant. FIDI's dividends also have an average growth rate of 7% per year, so your income stream grows alongside your investment. If you're planning to invest $100 per month, just like we've been doing, let's take a look at how your investment could grow over time. After 1 year, your saved investment will be worth around $1,200. Pretty straightforward. After 10 years, your FIDI investment could be worth $17,719. Fast forward to 20 years, and you're looking at $84,041. And here's the real kicker. After 30 years, your investment could grow to an impressive $685,168. By the end of those 30 years, your FIDI investment will be paying you $147,611 in dividends, with monthly dividends reaching $12,301. Let's talk briefly about capital appreciation. Unlike FIGB, which focuses purely on income, FIDI does offer some growth potential. The average share price appreciation for FIDI is 1% per year. So while most of your returns are going to come from dividends, you're also getting a bit of growth as the stock prices of these international companies appreciate over time. Over the course of 30 years, the capital appreciation could add around $28,343 to your portfolio, giving you a nice little boost on top of the dividends. When it's all said and done, the total value added by your investment in FIDI after 30 years could reach $649,168. Of that, $620,825 comes from reinvested dividends and $28,343 comes from capital appreciation. It's a win-win, steady income with a bit of growth on the side. At number 3 on my list, I have the Fidelity Growth and Income Portfolio, or FGRX. This fund doesn't just give you dividends, it also aims to grow the value of your initial investment over time. So how does FGRX pull this off? It invests primarily in large-cap US stocks, the kinds of companies that are well-established, have a solid track record of paying dividends, and still have room to grow. These are the household names you've probably heard of before, companies that dominate their industries and generate consistent earnings. That's why this fund is particularly attractive to investors who want a steady stream of income while also benefiting from long-term growth. Right now, the fund is paying out a dividend yield of 2.31%. That's a bit lower than some of the other options we've discussed, but remember, this isn't just about income, it's also about growth. The companies in FGRX have an average share price appreciation of 8.56% per year, which means your initial investment has the potential to grow significantly over time. So while the dividend yield is lower, the overall returns could be much higher because of that capital appreciation. Now let's break it down in terms of actual numbers. If you're sticking with your $100 per month investment, after 1 year, you're going to have your usual $1,200 in contributions. By then, your investment could be worth around $21,154. After 20 years, your portfolio could grow to $109,576. But here's the big one. After 30 years, you could be sitting on $772,027. Speaking of dividends, by the 30th year, you'll collect $102,305 in annual dividend payments. That translates into monthly dividends of around $8,525. What about capital appreciation? Well, here's where FGRX really shines. With an average annual share price appreciation of 8.56%, you're looking at significant growth. Over the course of 30 years, your total capital appreciation could reach $298,129. In total, after 30 years, your $100 per month investment in this fund could result in $736,027 in added value. This includes $298,129 in capital appreciation and $437,898 from dividend reinvestment. If you think these returns are good, wait until the end, where I'll show you a Fidelity Index Fund that has the potential to turn your monthly contributions into a portfolio worth over $2 million and pay over $40,000 in monthly dividend income. Alright, now we're stepping into the fast lane with a fund that's all about growth. The Fidelity MSCI Information Technology Index ETF, or FTEC. If you're looking to ride the wave of innovation and capitalize on the explosive growth of the technology sector, this fund is where you want to be. But let me warn you, this is a higher risk, higher reward play. So if you're in it for the long haul and can handle a little volatility, FTEC could be one of the most powerful tools in your portfolio. This index fund gives you exposure to some of the biggest and most innovative tech companies in the world. I'm talking about household names like Apple, Microsoft, and Alphabet, Google's parent company. These are the giants driving the digital revolution, and their growth potential is enormous. Over the past decade, the tech sector has outperformed many other industries, and FTEC allows you to tap into that growth with one investment. Here's why this fund is exciting. While the dividend yield is on the lower side, currently sitting at 0.65%, that's not really the point of this fund. The real magic happens in share price appreciation. FTEC's companies have an average share price growth of 20.31% per year. So let's talk numbers. You're still sticking to your trusty $100 per month investment. After 1 year, you'll have your usual $1,200, but things start really getting interesting after a decade. By the 10-year mark, your investment could be worth $32,367. Fast forward to 20 years, and your portfolio could have grown to $242,610. And after 30 years, you could be sitting on a massive $1,593,886. That's nearly $1.6 million from just $100 a month, all thanks to the power of compounding and the explosive growth of the tech sector. Now, let's not forget about dividends, even though they're not the main focus here. By the 30th year, you'd collect about $1,606 in annual dividends. Sure, it's not a huge number, but again, the real value is in how your shares are increasing in worth over time. Speaking of capital appreciation, FTEC's massive growth potential means that over 30 years, your total capital appreciation could reach $1,545,357. That's where most of your returns come from. Those tech stocks just keep growing in value as companies like Apple and Microsoft continue to innovate and dominate the market. If you reinvest your dividends along the way, your total dividend reinvestment would add an additional $12,529 to your portfolio. So the total value added after 30 years could be a mind-blowing $1,557,886. And now, for me, taking the top spot for both dividend and capital appreciation is Fidelity Blue Chip Growth Fund, or FBGRX. If you're ready to aim high and want to invest in companies with serious growth potential, this is the fund for you. It focuses on blue chip stocks, but not just any blue chip stocks. Here's what makes FBGRX a standout. It's all about investing in companies that have a proven track record of success but are still growing rapidly, and also increasing dividends. This fund is ideal for those of you looking to maximize capital appreciation over time. It's a bit more aggressive than the other funds I've covered, but the potential rewards are much higher. So what's the catch? Well, as you can imagine, with the potential for high returns comes a bit of risk. FBGRX is a growth-focused fund, so while the share prices of these companies can soar, they can also experience sharper dips than more conservative investments. But if you got a long-term horizon and are willing to weather those ups and downs, this fund could be a powerhouse in your portfolio. Let's get into the numbers. Right now, FBGRX has a dividend yield of 0.21%, which you might think won't make a huge difference, but when you look at the dividend growth rate over the past 10 years, it's a completely different story. Over the last 5 years, the fund has increased its dividends by an average of 33%, and not to mention the share price appreciation, which is averaging 13.31% per year. Now, if you're investing $100 per month, here's how that plays out. After 1 year, your investment will be worth around $1,200. After 30 years, your portfolio could grow to $23,186. Fast forward to 20 years, and that number jumps to $134,439. But here's where it gets truly exciting. After 30 years, your $100 per month investment could be worth a staggering $2,312,910. Let's not forget about dividends. By the 30th year, you'd collect $586,705 in annual dividends, which translates to around $48,892 per month in dividend payments by the end of that period. As for capital appreciation, Over the course of 30 years, your total capital appreciation could reach $798,270. Combine that with reinvested dividends, which add another $1,478,640, and you've got a total value added of $2,276,910. That's why this fund is a favorite for investors who are willing to go all in on growth stocks. Want more? Click the video on the screen to find out how to turn $100,000 into a portfolio valuation of $20 million.